All right, so this is module 6. In module 5, we talked a lot about options. In module 6, we're going to continue talking about derivatives, but with swaps. And so futures and forwards and other types of derivative securities that are not options. But you're going to see that they are similar to. That's why we start with options and then expand. So futures and forwards are going to look like options. However, an option, as the name says, option, you have the option whether or not to exercise, where futures and forward contracts are contracts that we will do. Regardless of what happens to the underlying, we're going to do this contract. It's not an option for either party, right? Well, this is just our contract. So we're going to look at how pricing works, and we're going to talk about risk management. We're going to talk a lot more about hedging. And so if you see here, I've listed several types of futures that we're going to look at, because what we're trying to do is minimize our market exposure, except in those areas where we wish to have some sort of risk, right? So it's not bad to have risk. You just have to properly plan for the risk and make sure that there's not hidden risk that you're not being compensated for. And so this is an example of a contract. So a farmer growing wheat may decide, hey, I want to lock in the price, right? And so a farmer and say a miller, right, that's going to grind the wheat into flour, they can go ahead and agree today on what the price is going to be in the future. So this would be that forward contract where we are going to, manage that price this way. Okay, and so when we talk about futures, instead of having the call and the put, or having the holder and the writer, right? What we're talking about normally is a long and short position, right? So when you buy the contract, you are long the position. If you sell the contract, you're short the position, right? And so being short means you have to deliver whatever the commodity is. So in the case of wheat, right, I have to deliver so many bushels of wheat as per the contract, right? And the person with the long position, they agree they're going to pay me the money to receive that shipment of wheat on that date, right? And we've agreed ahead of time what this price is going to be, right? So we could set up the agreement when I plant, and then when I harvest, you've already locked in what your price is going to be. So in the event there's a bumper crop and everybody does really well and prices fall, you still have to pay me more, right? And I've locked in that price. However, if it goes the other way and prices shoot up because there's not a lot of production, but my production is still happening, I can then deliver to you, and you locked in that lower price, even though the current market price would be much higher. Right. Here's a bit more. I'll let you read through it. But it's what happens, much like when we were writing the contracts for the options, right? All of the payout on one side was equal to the negative payout on the other side. Same type of thing, where all of the gains on one side of this futures contract is made up for on the other side of the futures contract. The money doesn't come from anywhere other than these two parties trading. Okay, and so and you can't go negative. That's because you have to fulfill your contract, right? It's not an option, right? We have a special name just for if it's an option, but yeah. So if you go long a futures contract, that's what it looks like. If you're short of futures, that's what it looks like. So every dollar increase in one is a dollar decrease in the other, right? You see that relationship, right? Where call options have a different type of payout. So while there's going to be a lot of similarities that we're going to talk about, these are the areas that we also need to see those differences. Okay. Now, understand that normally these positions will go through a clearinghouse, right? And so this is for us to track all of these positions, right? Because we have all of these open contracts and we need to have some, some central location, right? And that's where the clearinghouse comes in. Right. When we talk about those contracts outstanding, open interest is how many contracts are out there, right? So it starts at 0 because there's no contracts until people write them, right? And then they will just go and begin those contracts. Understand it's really hard to sell the contract, right? So when you want to get out of the contract, what you do is you find the other side of the contract and you enter into that with someone else, and then those two are paying each other off, right? And you notice this last bullet point, only 1 to 3% of contracts result in actual delivery, right? Most people that are involved in this trading are not the farmer and are not the miller, right? There are lots of other intermediaries that are trying to stabilize price, right? And arbitrage away issues that develop with price, right? So very few people actually want delivery of a whole bunch of oil because only refineries really want all this oil, right? And a lot of people don't want a whole bunch of wheat. Only people that are producing food out of the wheat, want that. So just understand that when we talk about how many contracts are out there in the dollar volumes, most of these are not actually going to be fulfilled. It's more about price discovery and price stabilization. So when you don't have a clearinghouse, then what happens is the long position goes to the short position, and then the short position delivers the commodity to the long position, right? So this is the farmer delivering the wheat to the miller, and the miller pays the money to the farmer, right? With a clearinghouse in between, if you notice, all of these positions go to the clearinghouse. The advantage of this is it eliminates that other party risk, right? So if we're just in this clearinghouse agreement and this farmer's wheat crop fails, right? Because we talked about, that happening. So if that were to happen, they still get a commodity because they're clearing this through the clearinghouse. So that's where the advantage of the clearinghouse comes in. It eliminates that second party risk. But normally intermediaries wish to get paid, right? So that's the other side. Okay, so whenever you write this, right, we assume at the end of the day that we're going to settle, right? Because you have to make good on this. It's not an option that you can choose to exercise. You are always going to exercise this, right? And so as it moves really far out of your position, you can get a margin call just like what would happen with any other margin account, right? And they will tell you what that, but when it happens that you have to, then pay that in, right? And then eventually we expect that the futures price and the spot price will converge when it exercises, right? So that, but until it exercises, there can be this difference, and that's why you would get the margin calls and things leading up to it. Normally at the day of settlement, there's a minor changes that need to be made, right? And so if you notice, there is a difference between speculators and hedgers, but once you're in the market, right, that aspect doesn't matter as much. It is, it's just other people in the market, right? So it's based, a hedger is using these futures to protect themselves, right, from rising and falling prices. So like the farmer and the miller, those are clearly people that are trying to hedge, right? Speculators are people that are trying to take advantage of mispricing and movements, right? But once they're in the market, they look the same, right? And we don't mind having speculators in the market because they help us get a better price, right? The more people that are in this market, the more trades we have actively engaged, the better we feel about the market. Okay, so the difference between the futures price and the spot price is this basis, right? And so eventually that basis goes to 0, but the basis will probably exist up until that point, right? Now, will the futures price be higher or lower? We'll get into that, where there's contango and normal backwardation. A lot of it has to do with, does the commodity require a cost to hold? But we'll get into that. Okay, this is just to let you read over this. As far as this calendar spread position, understand that a lot of trading happened in the last month, right before delivery, right? But these contracts can be, a year out. So you can have multiple positions at multiple times during the year, which is not at all uncommon, right? Especially for continuous operations, a refinery or a giant mill, General Mills, when they're buying corn to make corn wheat or corn puffs or whatever. When they're buying those types of commodities, they're continuously buying them, so they're constantly using these over some time period. All right, and this is the spot futures parity, basically saying that these they're going to eventually converge, right? That's what we're getting at. Okay, so what happens, right, when there's this difference? This relationship, this cost of carry relationship. Remember, sometimes it costs money to store gold or to store oil, right? That kind of thing. Or if I borrowed money, right, then I have to pay back that loan, right? And those types of things, because we deal with interest rate contracts and that sort of thing as well. And so this right here would be opportunities to look for arbitrage possibilities, because some of these prices won't be properly reflected. Okay. And then this right here is I'm just sort of showing you these. So like the time or the futures contract, the spread, right, at time 1 is equal to whatever that underlying is, and then you're going to multiply this by 1 plus the risk-free rate, and then we're going to subtract off D, where before we were found that D was equal to this dividend portion, right, divided by the stock price, right? So it's that rate, the dividend rate, right? And then you would go, you could keep raising this to that power, or if that this would be, let's have T1 to T2, or you could say, okay, well, it's T1, and then we would just grow it, right? So the spread would continue to go that way, right? So if the risk-free rate is greater than D, then the futures price is higher, right? If the risk-free rate is less than D, then the long maturities will be lower, right? So just understand that this is where we start talking about the contango and normal backwardation, has to do with that rate. Okay. Foreign exchange futures are another futures contract that we can enter into. And we would say that in time, we would expect the interest rates to converge, right? So when we start looking at what this difference in interest rates, say in two different environments, the US risk-free, and then what the UK puts out as their risk-free, right? Then we would have whatever the current exchange or the interest rate spot is, and then use that to derive what the forward rate would be. So forwards tend to be these ongoing contracts, and they could be multi-year contracts. And you'll see like banks engage in these when they have operations in multiple jurisdictions. All right, and then direct exchange rates, would be like the dollars per unit of this currency, right? And then indirect exchange rates is how much of the foreign currency per dollar. So it looks very similar, right? It's just which one, are we talking about? Know that most exchanges internationally are done in dollars, right? The US dollar is the global medium of exchange. So almost all of your international contracts will be paid through dollars, which is why we quote things relative to dollars. And then this is an example of using, like futures or whatever to offset this risk. And then this would be an example of how you would use that as risk management, coming up again with a hedge ratio to protect this position. Okay. So just as we had, these forwards and futures contracts on, well, the forwards, we were using exchange rates, futures contracts for commodities. You can also have, futures based on like stock indices, right? And so you can, like the S&P 500 contracts, right? If you want to get some sort of futures based on what the stock market itself will do. Again, if you have a basket of securities and you're trying to hedge the risk, you can also use these kinds of contracts for that as well. And then you can also create synthetic holdings in stocks using these stock index futures. Notice here, it talks about the transaction cost being much lower. It's because I'm not buying thousands of stocks, right, and paying thousands of these transactions. I'm engaging in one index, right, and so that will definitely help in creating this. And it's easier to get in and out of this position because I don't have to unwind all these separate ones. It's just this index, right? And you notice here they talk about index arbitrage. This is exactly how exchange traded funds stay in position. The ETF is based on some basket of securities. And when the value in the market of the ETF deviates from that, then it's in the interest to either issue more ETFs, if that's where the mispricing is, or to buy the ETFs and sell the basket of underlying if that's where the mispricing is. And so the people that make the ETFs are constantly arbitraging away those types of positions. But it makes the ETF price more accurate. And they're also making some money off of the arbitrage, right? So we basically are paying them to keep our prices fresh. Program trading is something that we don't do too much as individuals, right? This is when you're rebalancing entire portfolios. And so a lot of times what you'll do is you'll have a very structured way of handling these settlements because it can cause a lot of problems within a particular market. And so we try to have these hit simultaneously and clear simultaneously when we're handling those. And then here's an example talking about hedging interest rate risk. So if you think about who is worried about interest rates, right? And the biggest people are going to be insurance companies, pension funds, people that are looking to have some sort of stable fund, right? And so how do we handle getting money too soon, right? And trying to figure out where to place it, or the money not quite being there when you need it as cash and you have to liquidate, and to minimize the risk associated with those. Okay, so we talked about futures and forwards contracts. And if you take that example of the forward and then extend it out, we can have this ongoing swap. interest rate swaps, foreign exchange swaps. We earlier talked about credit default swaps. That's also one of these types of swaps. But what it does is allows you to enter into these positions to change your profile, to lock in like a particular exchange rate. If I have operations, let's say it's a German firm like Mercedes and they're building Mercedes vehicles in the United States, then they're going to be dealing with dollars as well as euro, because back home they need euro. And so they may lock in what this dollar to euro exchange rate will be to make it easier for them over time, because they don't want the individual actions to throw things off and derail their ability to access capital. Now, why have a dealer, right? And it goes with that second party risk, right? So you'll see sometimes where people need to go from a fixed rate to a floating rate, or floating to a fixed. And using a bank as an intermediary instead of going directly with someone else, is you're dealing with someone that's less likely to default, right? The bank is less likely to default. And so they will do that, but they will do that for money, right? Like they're to act as an intermediary, they're going to take a little bit of the profit. So let's just see what that looks like. Company B, and company A, they each have their own payments that they're making, right? So company A, right, is paying a 7% coupon, and company B is paying LIBOR, and LIBOR is a floating rate, right? This changes every day, and this one is locked, right? But if this company wants a floating rate, something like LIBOR, and this company wants a fixed rate, then they could try to work out a deal among themselves. But instead, what we're going to do is have this swap dealer, right? And company B, they will agree, I will pay you LIBOR and you pay me 7.05. And they make a deal with company A, you pay me LIBOR and I will pay you 6.95. Right now, why would these numbers be different? It's the credit ratingness of the whatever these companies are. This is a contract that the swap dealer, the bank, or whoever will sign with each of these. Just know that they're going to build in some profit for themselves. Like this right here would be 10 basis points, right? So they get 10 basis points just for acting as the middleman, where they are on the hook if company B goes bankrupt or company A goes bankrupt. They're still handling the other side, right? But if you look at company A, now company A is receiving 6.95 and paying 7, and also paying LIBOR. So what they're doing in effect is they're paying LIBOR plus 0.05% or 5 basis points. So LIBOR plus 5 basis points. This company here, they're receiving LIBOR and paying LIBOR, so those cancel out, right? And instead of paying LIBOR, they're now just paying 7.05%. So they now have their fixed rate they wanted. They now have the floating rate they wanted, and they're both happier with this outcome. And since swaps are just a series of forward contracts, right? Then basically what we're doing is we price those swaps, just like we've priced everything else. Yes, the present value of these future cash flows, and so you see we discount these back, and we would just find at what price would these equal, right? And it's a function of those what the forward contracts are. Okay, so we talked about a credit default swap before a few modules ago, but now that we're in swaps, we're going to talk a little bit more in detail about what this looks like, right? So it looks like insurance, but it's not, because you don't actually own the asset. You own the cash flow from the asset. So just understand that we have that. And this right here where you're modifying it, daily. If there's a credit default, the event were to happen, then the swap kicks in just like all of our other contracts, right? It's just the trigger is this credit default, right? So it's like it's tied to the financial status on that firm. Okay. And so this is a little bit, I've already sort of talked about this, but we have some slides that's talking about the price of carrying those commodities. And so, they mentioned like spoilage. And so anything that could happen, right? And sometimes it's just the cost of, how much does the warehouse cost, or how much does an oil tank cost? And so, several $billion can sit on a multi-million-dollar oil tanker, right? And so sometimes even like the ship itself can act as storage. But yeah, so we have to build those prices in. And so then we have to remember we carry the price, right, of what it is to hold that commodity. All right. And so we have to remember we have to include that when we're pricing our futures contract, because this is a physical good that has to go somewhere. Right. And so I'm going to deliver the oil, but in the meantime, I have to keep it somewhere. And so I have to price that in. The formula that we have, they point out this works well for gold. Wheat can rot, right? And so since you can't store that nearly as long term, and things like electricity, you cannot store it all. Right, we're constantly using the electricity we generate. There is no grid storage, right? We've talked about that, but there's no way to really store electricity at scale. So you really can't stockpile that. So those markets behave a bit differently. But that will conclude module 6. So modules 5 and 6, this was module 5 covered options in great depth, and then module 6 were other derivative securities. This is going to be exam 3's material. So as you're preparing for exam 3, it'll be these last two, modules 5 and 6. Thank you.